So do you like giving the government more money than you should? Of course you don't. But I bet you're making one of these mistakes and you're doing exactly that. So here are 5 mistakes I commonly see people make with their tax return that's costing them money. Now the first one, I always get pushback when I tell people about this mistake. So what's the first mistake? You're getting a refund. You don't want to get a refund. You actually want to owe them money, or maybe be as close to zero as possible. Now I know people love getting a refund. I see the joy in their face when you tell them they're getting a big refund. They start thinking about the vacation they can take. They start thinking about some of the bills they have to pay. But it's a horrible financial mistake. And why is that? Well, when you get a refund, when you file your taxes, what you're basically finding out is you are giving the government too much money every single pay period. You're giving them too much money, they're holding that money, and you're not getting any interest on it. And then when you file your taxes in February or March or April, the government's basically giving you your money that you overpaid them. The reality is what you want to do is actually owe them money. So that means the government's giving you an interest-free loan every single month. And when you start to think about it, it's called the cost value of money. If, let's say, for instance, you get a refund every year about $2,400. That means you're giving the government $200 every month that they're holding, and they're not giving you any interest. What if you got that $200 every month? What could you do with it? Well, if you have credit card debt or any other kinds of debt, you could pay your debt off quicker. That means you're paying less in interest on the total value of the credit card debt. So you're saving money by getting that refunds during the month rather than letting the government hold it. Or let's say you get that money and you put it even in a bank account. Even at 1%, you might get maybe 20, 30 bucks over the course of the year. That's not a lot of money, but it's 20 or 30 bucks you wouldn't get if you let the government hold it. And if you took that money and then you put it into, say, a 401k plan, now you could get even more growth, plus you get a tax break for putting the money in the 401k. So the first big mistake I always see is people getting big refunds. You don't want a refund. The second thing I see is people are missing out on some small deductions, but small deductions can be very powerful over time. The biggest area that I see is usually things like charitable miles, medical miles. So if you're able to deduct your medical expenses or you're deducting charitable expenses, a lot of people don't realize you can deduct the miles. So for medical, if you're driving to see the doctor, if you're going to the dentist, if you're picking up a prescription, those miles are actually deductible. You can write that off. You just have to make sure you keep a good log of what's going on with all those miles. Same with charity. If you're going to work at a Habitat for Humanity site, the miles from your home to the site are deductible. Another thing on charity that a lot of people forget about is if you're going to nonprofits and you're providing some sort of compensation in the forms of, let's say you bake cookies, or you buy some cookies at the store and you take it in. So let's say you're helping out at a school and you're taking in some food. That's actually deductible. It's a charitable deduction. You need to track it. You got to keep the receipt. But that's something that I find a lot of people leave on the table that they're not doing. So looking for some small deductions that they're not normally thinking about really adds up over time. The third thing that people make a mistake with is still on the deductions, but it's not really knowing what deductions they have. People don't track it. So if I'm doing a tax return for a client and I start talking about deductions, I always get the answers in the air look. So it's like, oh, did you have any charitable deductions? And they start looking up in the air to see what they had. They don't know. So what that does is people typically will underreport their deductions because they're afraid that they get an IRS audit. So if you track your deductions throughout the year, you're going to have a much better or more accurate depiction of what your deductions are, which means you're going to get the maximum refund. You won't undercut that because you're afraid of getting an audit. The fourth mistake I see a lot of people make is on the investment side. So if you don't have investments, maybe it doesn't apply to you, but a lot of times people will have losses in certain positions and they don't take them. So the government allows you to deduct up to $3,000 every year for losses on investment positions. So if you bought Apple stock at $300 and you sold it for $200, you took a loss, you can actually deduct that on your tax return. And I find a lot of people won't do that, but when you have a loss, it's a good idea to take it. Now you can buy a similar position after you take the loss. So if you had, say, an S&P 500 fund from Vanguard, you could buy a total stock market fund through Charles Schwab or Fidelity. So it's very similar. You're probably still going to get the same kind of return, but now you've taken that loss and you can deduct it this year. Again, time value of money. If you can get a loss now, write that off, save some taxes, that has a big impact over time. The other thing is, if you have gains, you definitely want to try to take some losses to offset the gains, reduce your taxes. Has a big impact. The fifth thing, it's kind of a nuanced part of the tax return, but it's called carry forwards. There are a lot of things that you carry forward from one tax year to the next. Capital losses, which I just mentioned, is one of them. You want to make sure you're tracking your information, because if you don't carry it forward properly, then the IRS is not going to allow you to deduct it. So capital losses is one of them. If you have more than $3,000 of losses, then you can only deduct $3,000 in the current year, and anything above that goes to it carries forward to the future years. So usually it's not a problem if you're using TurboTax or if you have a tax preparer that's in their software. It'll just pull it forward automatically. But if you switch preparers or you switch to a new tax platform, a lot of times that doesn't come with it. And then if you forget to go in and put that in there, you've lost it. One area I see this a lot is with non-deductible IRAs. What's a non-deductible IRA? Well, usually when you put your money in an IRA, you get to deduct that amount up to $5,500 for people under 50 or $6,500 for over 50. Well, if you hit certain income levels or if you have a plan through work, sometimes you can't deduct all of that. So part of it becomes non-deductible. Well, the problem with that is you have to track it on your tax return using a form called 8606. It's up to you to track it. The IRS is not tracking it for you. So every year you have to carry that forward so that eventually when you retire and you start pulling out from your IRA, a portion of that won't be deductible or won't be taxable because you weren't able to deduct it in the current year. You have to track it. So this is something you might have to track. It's a carry forward for maybe 10, 20, even 30 years. It's kind of a pain, but it's a way I see people lose money all the time. So today you learned the top 5 tax mistakes I see people make all the time. 1, receiving a big refund. 2, forgetting small but important deductions. 3, not tracking your deductions through the year. 4, not taking capital losses when you have them. And then 5, not tracking your carry forward items on your tax return. Hey, thanks for watching this video. If you could, just like the video below, and you could also leave some comments. If you have any questions on this video or any other money topics you'd like us to discuss, let us know. We'll try to help you out. But the big thing is, remember, right now matters. Don't wait till tomorrow to take control of your financial future. So now you're one step closer to saving yourself from Wall Street.